Imagine you're retired and it's March of 2020. The market just dropped 30% and you have a paper loss on your portfolio of $180,000. Your mortgage is due in 10 days. What do you do? Well, all of your money was all in stocks. You were all gas, and now you have to sell stocks at a loss. That is detrimental to your portfolio and your retirement planning. But what if you had a pile of cash sitting there untouched by all that chaos? Let's talk about why this is the game changer for your retirement.
Today, actually, I just had a client meeting yesterday that kind of focused around this subject. Basically, the idea of having a strategy, having kind of a bucket of money, if you will, available to you in cash and cash-like investments that you're going to be pulling your retirement income from, at least a portion of it.
Yep.
So, we always, when we're teaching the college class, we had something called like the 3-bucket strategy.
Yep.
Yeah, and in this one, we can talk about 2 pots is kind of what we're going with here. But basically, go ahead.
Yeah. So, all right. So to kind of touch base, because your 3-bucket strategy, you got your short term, your midterm, and your long term money, right? The short term, it cannot be that volatile, right?
Yeah.
And this is we're shrinking it to 2, because we can take a look and say, all right, what if with interest rates the way they are at roughly 4%, could we sidestep bonds possibly and put our money in a money market, right? I know bonds did well yesterday, but there's a possibility bonds could go down. So maybe you split this strategy. So the idea would be to have a safe bucket and have one that's all growth.
Right.
Now, so think about this. A bear market recovery in a policy-induced, a downward spiral, right? The market's down over 20% because of tariffs or conflicts around the world or something that is policy driven, right? It's not a fundamental breakdown like high unemployment and super high spiking inflation, things like that, right? So like there's fundamental and policy. The policy rebound is somewhere between 6 to 12 weeks. Like it's very short. It's extraordinarily painful, but it's very quick.
Right.
Where more of a fundamental breakdown, like, hey, unemployment's high and, and like there's the GDP's negative, like there's, negative growth in the economy. That's a 1.5 to 3 year move. So the idea by today's conversation is like, what if we put enough money aside to let you be, I'll just call it quote unquote, all gas, right? We're all gas and we're all stocks. But I now do a back calculation saying, hey, with Social Security, I need to pull out, $60,000 a year to sustain my lifestyle. And if I multiply that by 1.5 years, I need to put aside $90,000. If you want to be really conservative and say, all right, Tony, I want to hunker down just in case it's a 3-year, like there's a bear market, we're down over 20%, and it takes 3 years to get back to quote unquote even. That's $180,000. Well, I would, just kind of backing into the math of like a 3% distribution rate. What's 3% times 60 at $1.8 million?
Yep.
All right. So you got to put 10% of your money, $180,000 of $1.8 million, in a money market. It is probably going to irritate you. It's making 3-4%, but it is there. It is the ultimate rainy day fund so that your portfolio can be on high octane.
Yep.
What are your thoughts?
Yeah. So I think it's one of the most important things that you can do in your retirement is have a strategy like this for your spending, because we always say that the number one breaker of a financial plan is having to sell stocks specifically at depressed prices to pay for your retirement.
Yep.
That's really going to be one of the main problems that people have that could cause their retirement plan to break.
Correct.
So, and that is also another.
And that's why people have always held bonds. They're like, oh, when the market's down, my bonds aren't. Well,
Right.
it happened 2 years ago where bonds and stocks were down. What did you do?
Yeah.
Right?
Yep, absolutely. So, so yeah, having a strategy for where that income is going to come from is probably one of the most important things that you can do. And we see this all the time, right? Where when people want to talk to us about their plan or maybe come in for a consultation, they want to talk investment, right? And obviously that stuff is super important, and we want to get the most return that we can with our investment dollars. But having a strategy for where the spending money is going to come from in case the market goes down is going to be able to sustain you to get to the other side of that market correction.
Yeah. So, all right, let me play the other side of the table here. And all right, we're market's going up, great. Things are great. I'm selling stocks at all-time highs, and I got my emergency reserve, and then the market's down 20%, like the tariffs, right? The last year in 2025, the tariff board came out, market's down 8, rolls out the tariff board, now we're down 20.
Right.
And we're like, Tony, well, we hit our line, like the market's down, like let's turn on that reserve bucket. Mm-hmm. Now it becomes like, when do you turn it off and start selling the stocks again? Because it is now you to do this strategy, you as an investor, you have to be prepared to, I guess, not the timing. It's timing.
Right.
And you pick something in the sand saying, hey, I am literally back to even, turn off the money market bucket. If you get scared and you back out and say, hey, I just want to leave the thing, I want to make sure this is real, that's where you need to come up with a defined entry point to turn on and turn off that bucket.
Yep.
Because you're like, hey, the market's back up, I'm down 20, but now my portfolio is only down 5. Tony, the momentum is going in the right direction. Should we start it early? Mm-hmm. So that conversation, that's the biggest thing. Just saying this in generalization, I run into this all the time. Even when it's dollar cost averaging time. Hey, I'm actually having a conversation with a client now. Our dollar cost averaging $300,000. $100,000 went in before the first of the year, mm-hmm. and he's been ghosting me to put the rest in. And I finally said, hey, are we ready to do this? And he's saying no. And I'm not there to push it. Right. I'm just there to remind him, this was the game plan. Mm-hmm. So I'm like, hey, the dollar cost average strategy is, he's hyper focused on, hey, there's a war, there's oil above $100 and inflation spiking.
Yep.
All right, well, today, that was yesterday. Today, oil's down 10%.
Right.
It could be back up 10% by afternoon. Who knows, right? But if the long-term strategy is that, hey, that it's still a bull market, we can't get in our own way of behavioral finance. And that's what we're running into. And this is the same thing. It has to be hey, if we're within 5% of the all-time high of your portfolios, it's the time to get in. Do we have to eclipse? Do we have to get back to where we were? The guidelines, the upfront contract, the guidelines need to be set, in my opinion.
Absolutely. Yep. It's a great transition to, how, and this is kind of what we're talking about. How do we refill that bucket, and when do we refill the buckets? It is probably the number one thing I have learned throughout time is that the more often you try to time the market, the more often you're going to be wrong.
Yeah.
It just does not work out very well. Because you have to be right twice, essentially, usually. So, if you're pulling money out because you think the market's going down, that's usually the easy part, right? Yeah. It's when to get reinvested is the difficult part.
I did a presentation yesterday. Timing the market's greater than timing the market. So there was a statistic, and don't hold me on the exact dates, but basically from 1995 to 2022. Okay, that's a long period of time. That's almost 30 years, right? 27, right? That's the math. So in that time, if you would just stay invested in the S&P 500, you would have made 7.8% or something along them lines. Very close. I don't know. I don't remember the exact number. I didn't write them down. But I was going through this yesterday, and think about all of the stuff that happened from 95 to 2002. Yeah. Like there was, there was like 5 incidents where the market was down over 25% in each, like 5 of them in that 30-year period.
Yep.
You still made 7.8% if you stayed invested. The next statistic said, hey, you only made 6% if you missed the 5 biggest days in the market in that 30-year window, that 27-year window. Your return got cut by 1.8% on an annualized basis.
Right.
Annualized, because you missed 5 days in 30 years. Yep. Well, guess what? Those best days are usually after the worst days.
Yes.
So if you pulled
2
flaps
weeks.
and you threw the parachute up, you probably earned 6% rather than 7.8.
Yep, absolutely.
So this is stuff, and again, the devil's advocate to this. It's easier said than done, right? Investing your money is a very emotional thing. Obviously, you don't want to. You worked your life to save all this money. You don't want to see it evaporated,
right?
But history, over 100 years of history, says that if you stay invested, is greater than trying to time the market.
Yep. And coming up with a strategy like this allows you to do that, right? When you don't have to sell at depressed times because your income is in a separate bucket or maybe even multiple buckets, you don't have to worry about that market timing. You don't have to worry about where your income is coming from because you already have a strategy.
Right. And I just one of the custodians that we use, Schwab, their money market mutual fund or something. It's paying on a net basis. Just call it between 3.5 and 4. It fluctuates day to day. I've seen it as over 4. I've seen it around 3.5. Let's just call it 3.5, right? Inflation's 3.5. It's keeping up with inflation at least, right? It's nothing sexy. 3.5. I can go get a better CD. I'm like, yeah, but this is liquid. I can buy it today and sell it in 2 days, and there's no issues, right? It's ultra liquid, and there's no penalties to get out. And penalties to get in, or commissions to get nothing. It's just a nice, simple bucket if this strategy makes sense to you.
Yep, for sure. So yeah, just a quick way to kind of calculate it. The first step is always calculating your expenses, right? So it's you don't have to have a to the penny budget to be able to do this. But I'd say one of the first key steps to planning for your retirement is getting an understanding of what you're spending money on, kind of what your standard of living is. So kind of taking your 12 months of kind of your essential expenses and using that as kind of the base. So let's say your base is $36,000 a year. That's kind of standard or essential expenses, things you got to have, food, utilities, stuff like that.
It's the delta from whatever you're not getting. If you got a pension, Social Security, things like that, whatever your delta is, whatever you're pulling from your accounts on a monthly basis, multiply it by 12, and then figure out, again, I mentioned 1.5 years to 3 years.
Yep, exactly.
Where do you feel comfortable of just making sure that money's hanging out doing nothing?
Yep, absolutely.
And the other side of this whole equation as we kind of wrap this up is I would say that a strategy like this is for more of the aggressive investor because you have to understand that all of your basically, 80 to, maybe between 80 and 90% of all your money is going to be invested in the stock market. If you watch your account on a day-to-day basis, you're going to be really upset and really pissed off about that. There's going to be highs and lows. But if you believe in the system and you believe in staying invested and you are or have been an aggressive investor, I believe this is a good strategy to consider.
Yep, for sure. For sure. And hey, I will, just before we wrap this up, I will mention real quickly, I will be starting to do a webinar here in probably 3 or 4 weeks. And it will be based kind of around income strategies and retirement. So, if you're interested in that, or someone who might be interested in a 45-minute webinar, drop us a line at info@swpconnect.com, and we'll get you more details on that, but should have links and stuff to provide in the next couple weeks. So keep an eye out for that. And any wrap-up key takeaways you want to close with here, Tone?
No, this strategy is just it's just a different mentality.
Yep. I think that's a great word.
I think it really, I don't think many people do this kind of strategy. I mean, they have their, moderate portfolio theory where they got a 60% in stocks and 40% in bonds and stuff. But if we're continuing to be in this melt up market environment, this could be a way to take advantage of it. But you better understand that it's aggressive, right? Because you're 80 to 90% all in on all of your money.
Yep.
When the other one's just hanging out doing nothing.
All right. Well, thanks everyone for listening this week. If you guys have any questions, comments, ideas for a show, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.